Good morning, everybody. Jamie Sumner here and Kyle Custer, your analysts from Seafried and Brew. And we're going to run over the employment situation. There's a little bit of good news, a little bit of bad news. So I think that's why we didn't see a lot of movement in the market. Even with this big 287,000 non-farm employment increase. Normally that would be great news, especially if we could keep that trend, but we didn't. Last month, only 11,000. So if you're looking kind of for the mean there, we're way below where a true indicator of growth would actually be with this indicator.
Yeah, the ironic thing with that, of course, is last month when we only had 11,000 jobs created, the unemployment rate actually went down. And then we have the increase here of 287,000 this month, and it actually went up to 4.9%. A little of a dichotomy there.
Yeah, and that's why what we'll get into a little bit is the LMCI, where you can't just look at one of the numbers. You got to look at the whole picture. And here's another part of that picture that came out with that employment situation report from the BLS. And what we found was that the weekly hours were slightly less than in 2015. However, hourly earnings were up slightly. So when we're talking about, you keep hearing no inflation, no inflation, no inflation. Well, there actually has been a little bit of wage inflation, and that's kind of dead on with the Fed's target. So although we're not really seeing it in the commodities, with the oil being depressed a little bit, the middle class might actually be picking up a tiny bit in terms of working a little less but earning a little more.
And hopefully that'll turn into additional growth here in the next couple of quarters for the GDP.
Hopefully. But of course, we have the whole global economic situation to get into. But we're not going to get into that today. Further into the employment situation report, what Jamie was saying was the unemployment rate actually increased even with that huge 287,000 pickup that we had. And that's in part because of labor force participation. We're seeing more people entering into the market, which is a pretty, that's good. Oh, so we had 62.6 and now we have 62.7. So that labor force participation increased. However, we are very far below our historical highs that were pre-recession.
That's right. And also when we look at the overall unemployment rate, as we know, went up to 4.9%, but the U6, the unemployment rate that includes all those marginal workers out there, those discouraged workers as well, actually went down to 9.6 from 9.7. So we saw a little bit of an improvement on that overall U6 number.
But I guess what we really want to see is whether that improvement did translate into our LMCI, which the Fed keeps saying is their go-to.
So here we have the LMCI, and just to refresh your memory, if you recall, the LMCI is made up of 19 different indicators that's put into this index to give a better or broader indication of the labor market. And we can see here, obviously in June, we come down to the release, and it's negative 1.9. So this is the 6th month in a row that we've seen a negative number. And with inside this index, the lower the number, the not as strong the labor market is. So with it being negative for so long, it kind of brings up some worries that maybe we peaked out here with inside the employment market. So when we come up to the FOMC meeting in a couple of weeks on the 27th, we could pretty much indicate, and the future markets is telling us this, that the Fed will most likely not move this quarter or this meeting or next meeting. And the question is, when will they begin this tightening strategy again?
So that's all we have for you this week, and we look forward to having you next. Thank you very much.
Have a great week, everyone.